When a bond is placed on the books at a discount, it is carried for a value less than its face value, which can be a problem for your books because we know that at the end of that bond's life, we're obligated to repay our bondholders the face value of the bonds back, which means we need some kind of systematic method to get rid of that discount over the life of the bond, so that the bond at the end of its life will have a carrying value equal to its face value. And there's several different methods to do this, but the easiest one, and the one I'm going to require you to know, is the straight line amortization method, which essentially means every time that we pay interest on these bonds, we are going to remove an equal portion of the discount until the discount is off of our books at the end of the bond's life. So in our example right here, we had an initial discount of $3,851. Well, this is a 5-year bond that pays interest semi-annually, which means in total, we're going to make 10 payments, 2 per year for 5 years. So over the course of those 10 payments, we're going to remove an equal portion of that discount from our books. And that is going to be $385, actually $385.10, but we're going to round off to the nearest whole number. And every time that we pay interest, we are going to remove that $385 of our discount. So the journal entry to record the payment of interest and the amortization of a discount on a bond is to debit interest expense, and we'll leave that number blank to start with. Then you're going to have a credit to discount on bonds payable, which is that equal portion of the discount coming off of your books. So we're going to credit discount on bonds payable, reducing that contra liabilities value by $385. And we're also going to credit cash for the amount of interest we're actually paying, found one more time by face times rate times time. These are $100,000 bonds at 9% that make semi-annual interest payments, and $100,000 times 9% times 6 out of 12 is $4,500. So we are paying $4,500 in actual cash as an interest payment. But we're also removing $385 of our discount, which GAAP allows us to record as interest expense itself. So our total interest expense is just equal to the sum of our two credits, which is $4,885. And after we make that payment, we will have a lower balance to our discount on bonds payable account. So let's say in this case that Smart Touch has made 2 payments on this bond, and each time they've made an interest payment, they have amortized their discount by $385. Well, that bonds payable is still on our books for $100,000 because the actual liability stays on your books in full until the maturity date rolls around and you repay it. So from now until the end of the 5 years that this bond gets repaid, it's always going to be on our books at $100,000. The discount, however, is going to continually get smaller and smaller as time goes on. We started at $3,851. Assuming that we've paid interest twice, and we would have recorded that same exact journal entry a second time, we would have removed $385 in value from that account 2 times, bringing its balance down to $3,081. And now, on our balance sheet, we will be reporting $100,000 in bonds payable, less a discount of $3,081 for a carrying value of $96,919. And here we have an amortization schedule for our bond. Our bond started out with a carrying amount of $96,149. Well, on our first interest payment, we paid $4,500 in actual cash, one more time, face times rate times time, and we amortized $385 in discount, bringing us to a total interest expense of $4,885. Well, to figure out what your new carrying amount is after you've amortized discount, you just take your last known carrying amount and add to it the amount of discount being amortized. So if we had an original carrying amount of $96,149 and we amortized $385 of that discount, it's going to bring our carrying amount up to $96,534. When we make our next interest payment, as we just saw on the last slide, we're paying $4,500 in cash again. We're amortizing another $385 for a total interest expense of $4,885. And to redetermine our carrying amount, we take our last known carrying amount, $96,534, add to it the amount of discount that's being amortized, $385, coming up to a total of $96,919. And we will continue to do this throughout the entire 5-year life of the bond Every 6 months, we are going to pay $4,500 in cash. We're going to amortize $385 worth of discount for a total interest expense of $4,885. Then we're going to add $385 to our last known carrying amount to find our new carrying amount. And as time goes on, we see that it keeps going up and up and up, closer to the face value of the bond. And after the last interest payment, we're going to have a carrying amount of $100,000, which is exactly the amount that we have to pay to our bond holders. So that is the ultimate goal with amortizing a discount. You're working towards getting it off your books on the day that the principal of that bond becomes due and you have to repay it. Let's do another example through here, and we'll see that Paradise Pets has issued $20,000 worth of 6% 4-year bonds payable, and they had to issue these bonds at a market price of 98 because the stated rate of interest is below the market rate. Well, they're issuing at a bond price of 98, which means the amount of cash that they receive, and start by debiting cash, is not going to be the full $20,000 of face value. Is going to be 98% of that $20,000. So to figure out what 98% of $20,000 is, we take 20,000, multiply it by 0.98. We come up with $19,600 in cash that they're going to receive. Well, we are issuing at a price below the face value, which means we have a discount that we're offering on this bonds payable that needs to go on the books, and it's the difference between the face value of the bond and the actual amount of cash we're about to receive. The face value of the bond is $20,000. We're receiving $19,600 in cash, so our discount is $400. And then bonds payable, like it always does, goes on the books with a credit for face value. And bonds payable in this case will have a face value of $20,000. And in this journal entry, we will have recorded the issuance of bonds payable at a discount. Then, on December 31st, Paradise Pets is going to make the first semi-annual payment on the 6% 4-year bonds, and they're going to amortize the discount. Well, first, let's figure out what our interest payment is going to be. To find interest payment, our face is $20,000 times our stated rate of 6% times 6 out of 12, because it's a semi-annual payment, comes out to be $600. So we're actually transferring $600 in cash for the payment of interest. We also get to amortize a portion of that discount. So to find out what portion we're going to amortize using the straight line method, we're going to have to figure out how much we take away in equal portions over each interest payment to reduce it to 0 at the end of the bond's life. We'll take the original amount of the discount, which on the prior slide we determined to be $400, divide it by the number of payments you're going to make over the bond's life. This is a 4-year bond that pays semi-annually, or twice a year. So twice a year for 4 years is 8 total payments. And if we need to spread that $400 out evenly over 8 payments, that's $50 of discount that should be amortized with each interest payment. So the journal entry to record the payment of interest and the amortization of this discount should start with a debit to interest expense, and it'll be for $650. The sum of the amount of cash being transferred for the interest payment plus the portion of the discount we are amortizing. We're going to have a credit to discount on bonds payable, reducing that account's value by $50. So we credit discount on BP for $50, and we have another credit to cash for $600.